Hello and welcome to Market Watch for the start of the week of the 13th of November 2017. Interesting to see what's gone on over the weekend around the statement of monetary policy, and I will come to that in a minute, but do want to have a look. Realistically, nothing's happening for the next 2 days. It's the back end of the week that really starts to ramp up, and it's Europe and the US to start me off. And the reason for that, preliminary GDP out of Europe. Question is whether or not Mario Draghi and those co are right. You do want to see growth in Europe, and the reason for it from an Australian-centric point of view is the inferred meeting sort of back through China. The Chinese are fully expecting to see a fairly reasonable ramp up in global growth, so is the IMF. And that's probably the way to look at this, is that if Europe does start to expand, demand for Chinese goods picks up, therefore, touch wood, the demand for Australian products also picks up as they use our bulk products. That's the first part, but the real part of it is around the inflation reads out of the US and also Europe. They come on Wednesday night, Thursday morning for us here in Australia. GDP is coming out next week for the US as well, so keep that in mind. But core inflation, it's a question of whether or not they now believe, with inflation unlikely to reach the Fed's mandate of 2%, probably in the next 6 to 12 months, and a new Fed president coming on along with Jerome Powell, gives them that reason to sort of move away. It's been quite interesting. The market's got quite volatile around this principle. It's actually ramped up with expectations of raising rates at the Fed. That's a real positive for us here in Australia. We do need to see a lower Aussie and do need to see sort of the carry trade that's sort of unfortunately at the moment slightly disadvantaging us moving away. But in saying that, look at those core figures. If it's not there, does that give the new Fed in February just a reason to possibly move away from the Fed's dot plots of 3 movements next year? Does it also suggest that inflation, despite the fact their growth is well and truly the bright spot in the global economy, just can't materialize, and therefore you have to continue to keep on with monetary policy? All interesting questions you need to look at. The other side is Europe, and as I said, Europe too has been struggling to get any form of inflation movement at all, and they realistically moved back towards an end they didn't want to be, which is around 1.2% on headline, 1.1% on the underlying. Again, if you started to see inflation moving away, with Draghi talking about sort of moving policy very gradually in 2018, it'll give him another reason to move away from saying we're going to move rates at all. But that's Europe, that's the US. Let's look at what really matters for us here, and that's on Thursday. And it's the employment numbers as always. Having a look at what happened in the statement of monetary policy, probably the bright spot out of it was that we actually saw they believe that job security, job creation, and the unemployment rate are actually going to be the real benefits out of what happens in the global economy over the next sort of 2 years. They expect unemployment to hit 5.5%. They even saw it as low as 5.25% midway through 2019. It might put back up, but that's a real positive. That's levels we haven't seen since sort of 2004-05 in terms of employment numbers, and we are on track for the best employment year since 2005. The growth of actual created jobs was sitting at 335,000 jobs to the last release. So if we see another really big jump up, that's an amazing movement, and certainly something that could be championed as a positive thing. The catch is that it's not translating into wage growth. Also, have a look at what's also happened this year is the translation towards full-time employment over part-time. Part of the reason, they've sort of been suggesting that the employment figures are sort of weak and there's still a lot of spare capacity inside of it, has been around the idea that it's been mainly part-time employment rather than full-time employment created. This year, there has finally been a switch, and if you look on a 12-month blended period, it is full-time that's actually picking up. So that's all the positive. So maybe Thursday could be a bit of a bright spot for us, but in the main, looking at what the statement of monetary policy said on Friday, we want a lower Aussie dollar, and even if you saw a pickup on the employment numbers and a pickup in the Aussie, structurally, it's heading lower, and that's where we want it to go.